Welcome back. Today is Friday, May 6th. The markets are closed. My name is Patrick Dunawilla. I'm the editor of the Chart Report. Joining me today is Steve Straza of All Star Charts. Steve, how you doing today?
Doing all right.
All right. So we were off last week. We were in Washington, D.C. at the CMT Symposium. That was a lot of fun. We got to talk to a lot of smart people, and it was great seeing you again, Steve. Did you have a good time?
Yeah, it was okay seeing you, mostly everybody else, but it's always fun getting the crew back together. A lot of familiar faces, you know.
I'm sorry to hear that you caught COVID. Are you feeling a little better?
No, listen, I caught COVID. Then I parlayed that with like the worst sunburn ever. So I'm a mess over here right now.
Well, we appreciate you joining us. It was a pretty boring week, right? S&P 500 just changed about 17 basis points. You could have gone to sleep last Friday, woken up today, and you would have saved yourself a lot of anxiety, because I'm joking. It was a crazy week. We had our best day in almost 2 years on Wednesday, gave it all back and then some on Thursday, and we ended slightly lower today. But like I said, all in all, just 17 basis points lower on the S&P 500. But when you look at it, that 17 basis point move was enough to be the fifth straight down week, which we haven't seen 5 straight down weeks for the S&P 500 in over a decade, since 2011, which, yeah, it's nothing more than a fun stat. But Steve, we've been closing at the lows of the week kind of for the past 5 Fridays now. What do you make of that kind of end of week action?
It's not bullish, right? But it's also not surprising at all. We've talked about it on here for several months now. You know, sellers have owned the intraday session. So that's what you're seeing. You're just seeing them own the close for each week. And
yeah. And these rollovers where you see us, you know, we're nicely positive on the week, and then we end up, you know, settling at the lows of the week. That's a pattern now the past few weeks.
Yeah. Yeah.
And
it's bear market stuff.
Yeah. And while the S&P 500 isn't in a bear market just yet, you know, it's settling at, I want to call it 52-week lows, but it's not quite a 52-week low. But the other indices, you look at the Russell 2000, that's in bear market territory, settled at a 52-week low today. We've been talking about that VWAP there in blue from the COVID lows, and we kissed it on Wednesday, but then smacked down again. So that's been a problem. And as long as we're below there, you know, risk off mode. And, you know, here's the NASDAQ, similar story below that VWAP from the COVID lows. You have momentum diverging positively. So could you have a short-term bounce? Sure. Given how sentiment is, you know, sentiment's very bearish right now. A lot of these things are really short-term oversold too. So could you see a bounce in the short term? Sure. But it could end up being like March, where, you know, it was kind of a fade the rally kind of thing. You know, the NASDAQ could rally 18% from here and it'd still be below a declining 200-day moving average. I mean, Steve, what would that look like? An 18% rally from here? I mean, you got to imagine people would get crazy bulled up, but we're still below a declining 200-day moving average.
Yeah, and that's what people need to realize too. If we had an 18% rally here, it's still bear market stuff. We see huge counter trend moves in bear markets. It's characteristic of bear markets, right? And yeah. What I would say, just looking at these charts, if I could just throw something in here, the NASDAQ and the Russell 2000 sitting right on their VWAP from the COVID lows, key level, right? If those VWAPs break in the NASDAQ and the Russell, look at the S&P, because they're still about 25 points away from their VWAP. And that's where we're headed.
Yeah, I mean, they've been leading the S&P 500 so far, so you got to expect that to continue. And in the words of Brian Shannon, kind of the father of the anchored VWAP, you know, the trend is guilty until proven innocent, right?
Yep. And just to Brian's, you know, the way he would teach an environment like this is we're below a declining 5-day moving average. So everything is guilty until proven innocent. That's the market we're in right now.
Yeah.
Want to fade these bounces. You saw it today. A lot of growth stocks bounced today, got faded. I think that's the environment we're in. That's to be expected.
Yeah. Well, so let's take a look at the sector performance. Energy, again, far and away the leader this week. It rose over 10%. And I feel like a broken record. And if I do sound like that, it's because we're trend followers, right? And trends persist. And so far this entire year, it's been energy, far and away the best performing sector year to date and this week and today. And let's take a look at it. I mean, it reclaimed that $80 level, right, Steve?
It's not just the best performing sector. It's really the only performing sector at this point, right? So like we've lost all the other leaders. It's just energy now. The bears kind of have easy work cut out for them. All they got to do is energy stocks. It's not much.
And I mean, I'm sorry for those of you who drive gas guzzlers, but gasoline futures hit another all-time high today. You know, kind of quietly, I didn't hear too many people talking about it, but yeah, here you have it. Gasoline and heating oil. Why don't you touch on that?
So like the big thing about these bases, right? These are crude oil derivatives. So basically you buy crude oil and you make these things out of them. If these bases are breaking out and resolving higher, reclaiming those 2008 highs, these are, you know, this is a decade and a half long base almost at this point. If these are breaking out, what do you think crude oil is doing? You better believe it's at least going to try and test those 2008 highs, which would put us back at 145. Wow. You know, how's energy doing in that environment? How are energy stocks doing then? You would hope that they're, you know, confirming that rally and doing well. There's got to be upward pressure on the space. Maybe that's kind of what we're seeing now. But again, energy, super resilient, stands out in a league of their own right now.
Yeah, and we saw crude oil kind of, you know, following gasoline too, resolving out of that kind of 2-month consolidation there, and making another go at that 1.618 Fibonacci extension from the 2018 to 2020 or 2020 decline. You know, what areas of energy have your eye still? Is it getting long in the tooth, or do you still see some opportunities?
No, if anything, we had a lot of the large integrated plays, the large multinationals, your Chevrons, your ConocoPhillips, your Exxons, kind of consolidating and digesting gains for the past several weeks. And we're starting to see some upside resolutions from the continuation patterns that have been in play for the past month or so now. And then also there's pockets of strength kind of emerging from other industry groups within energy. Refiners really stand out. We've been all over refiners. Crack spreads are making new highs. Gasoline is making new highs. Now you're seeing refining stocks break out. Valero, Marathon. It's all working. I think that's a space to look to for long opportunities right now.
Yeah. But, you know, it's not earlier in this year, we saw commodities kind of broadly rallying together. You had the metals, you had the agricultural related commodities, but you know, dare I say there's been a little bit of a divergence within commodities. Do you want to touch on that a little bit? You know, some of the metals haven't been participating lately. In fact, they look pretty crummy, and so do those mining related stocks as well.
Yeah. So like the first quarter of 2022 was characterized by just commodity stocks ripping. You know, it was all working. We were firing on all cylinders. So you had your agricultural stocks doing well. You had your industrial metal stocks doing well. You had your energy stocks doing well. Precious metals kind of joined the party for a little bit there, acted like they were ready to break out of a little bit of a base there. Didn't, but we're seeing a lot of them kind of fail now. So anything in the materials space is kind of come under pressure. So energy is in a league of their own, like we just talked about. And then the rest of these commodity stocks are getting hit with the broader market. So when I look to commodities, the futures market, go back to the last chart,
sure,
you're getting a bit of a divergence here, right? That you really want to pay attention to. Commodities are still working. They're still making new highs. They look great. But when you look at inflation expectations and commodity stocks, they're starting to, you know, shout out some warnings, right? And I think we want to pay attention to those, especially as participation continues to get narrower and narrower. For the stock market in general and for commodity stocks, right? And by that, I mean, it's just energy. You no longer have the materials names. I think that as an investor or a trader, that would make me feel less comfortable holding a long position in what is still working, right? Because as more and more leaders get knocked off, then you have to, if you're standing there holding the only leader that's left, you got to wonder, okay, are they coming for me next? Right. And that's how I would feel as an investor in energy stocks right now. That's all that's left.
I see. So if I understand you correctly, you're still kind of bullish energy, but kind of there are some warning signs that we haven't had before. Is that correct?
I was still bullish energy 4 weeks ago, but I was more comfortable holding long exposure in energy, knowing that other commodity trades were still working. Now that these other commodity trades are not working, I'm sitting here wondering, yeah, energy is still working. So I'm going to trade what's in front of me, but I'm almost anticipating that to stop working. I just don't know when.
Yeah, I see what you're saying. So, we got to touch on the 10-year and what's going on in bonds, because that has just continued and it's driving a lot of the other asset class trends that we're seeing. As yields move higher, tech continuing to get crushed. And, some of the more value names definitely benefiting, like energy and stuff like that. So we finally crossed above that 3% threshold on the 10-year. Not that there was resistance there, but it is that kind of key psychological level. And now we're at those 2014, 2018 highs. Steve, do you think, can bonds finally catch a bid here? I mean, they are just falling like a knife.
Yeah. So can they catch a bid? Maybe. I would be more comfortable saying you don't want to press shorts in the bond market right now. Will they catch a bid? Yeah, eventually. I don't know when and what that bid might look like, right? It could be a really lazy counter trend move at this point, or we can get a quick ripper. Hard to say. If you look at this chart of long-term treasury bonds, in the lower pane, we have their distance from the 200-day moving average, right? So this is just telling you how extended we are from the mean at any given time. And this is a record extreme, right? Bonds have never been this oversold, this extended, however you want to put it. So we should anticipate some sort of, mean reversion to occur here. It's just, we don't know when, and we don't know what it will look like. So for the bond market, I would just say it's not a time or a place to press shorts, but still getting long is kind of cute, if that makes sense.
Yeah. Kind of one of those similar things where we could see a rebound rally, but a lot of those longer term trends are pretty broken, right?
Right. And listen, this has been extended. I could have showed you this chart 2 weeks ago. We were at...
We did. We did take a look at it 2 weeks ago.
Did we? Okay, great. So exactly. I've been looking at it. It's been extended and bonds keep falling. So this isn't something you should look at like, oh, what a great trading signal. Let's get long. No. It just means don't be short here. Don't be short on a tactical basis. That's risky. You don't want to do it.
Right. Well, Steve, we got to wrap it up. But before you go, what is the chart on your mind going into next week? What's on your radar?
Yeah, the dollar index, that 104 level.
Oh, yeah, that one. Why don't you walk for people who don't know how the dollar has been driving kind of other asset class trends in stocks, crypto? I mean,
listen, if you're a commodity investor and you've been bullish, you wouldn't even know that the dollar's been this strong, right? In a typical environment, a stronger dollar puts pressure on commodities. We've had a strong dollar, but commodities have still been doing great. So it's one of those situations where it's like, all right, if commodities are doing this well with a rising dollar, wow. Imagine if that upside pressure were to come off, dollar were to go sideways or God forbid even lower, what would commodities look like then? You'd have to imagine we're doing a lot better and we're already doing very well. The other thing, the other implication of a stronger dollar is really international stocks. Stocks in general tend to do better with a weaker dollar, but it's really ex-US stocks, right? Stocks, any asset denominated in not in US dollars, right? So international stocks have been under pressure. And I think a dollar rolling over, cooling off could do a lot for the damage that we're seeing internationally right now. That would be a big feather in the hat for bulls. So if you're bullish, you got to be rooting on the dollar to kind of falter here or roll over. But at the same time, there's really no evidence that suggests that's about to happen.
Yeah, it has just been on fire lately. So, it's at that key level. That's your point, right? That call it 104. And if it does roll over, that would be nice for stocks, emerging markets, as you're saying, international stocks, and maybe even crypto. But as you said, no sign of that yet. I mean, it's breaking out. Did it break out to those multi-year highs this week? I didn't see.
No, I don't think so.
Oh, okay.
It hasn't made a decisive upside resolution yet.
Awesome. Well, Steve, let's wrap it up. Thank you so much for coming on, despite the COVID and everything. It was great hearing your thoughts, and we look forward to talking next week.
All right, man. Have a good weekend.
You too. Well, thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.
I appreciate that you're not wearing just a white t-shirt today.
I tried to wear green in hopes the market would go up, but didn't quite work.